Sivaram joins us now. Let's take our conversation forward on where he feels market is headed. Sridhar, good morning. Thank you for joining us. Sridhar, we can divide the market into two camps. Those who are participating and those who are not participating. Needless to say, those who are participating, whether it's momentum, whether it is long-term investing or whether it is sheer liquidity, they are happy. And those who are not participating are feeling terrible and left out.
So what's the question? We are in the market, so we are always invested.
So what should one do?
I think some bit of caution is required because the markets have run up, very fast. I was looking at the data for the last 10 years for Nifty because we keep hearing that markets always don't need earnings. There are momentum, there is liquidity. So just look at the last 10-year numbers. Index was about 5,500. Nifty was 5,500 10 years back. We are at roughly 11,000 plus minus a few hundred points here and there. So that's about 7% compounded return. Earnings for the last 10 years was roughly about 5%. And inflation for this period was roughly about 6%. So if anybody said that markets don't need earnings, liquidity, and all the others can take the markets up, yes, it can for a brief period, but we need earnings to come back. So what I think the market's currently betting on is that earnings for 21-22 will rebound very sharply. If it does, then markets ride and it moves on from here. And if for whatever reason that assumption doesn't fall through, then we'll see a correction, as we've seen over the last 10 years, that if your earnings don't come through, then there's only that much that the markets can return. If you ask me my view, I think markets run up slightly ahead of what it should right now because of liquidity, global factors. But in many cases, we also find undervalued stocks in the market. So I think it's a question of how you pick your stocks, how you select your sectors, and how you position your portfolio for what is to come tomorrow and not what is moving up today.
Most of the companies are saying the following, that demand is back. Some of them are claiming that it is back almost 85% or 90% to the pre-COVID levels. What is the right way of looking at the management commentary right now? Because, when a bank comes and tells me a moratorium number, every bank is using a different yardstick. So when companies are coming out and telling me that my demand is back to pre-COVID levels, it becomes very difficult to understand because auto demand was very different when in the pre-COVID level. Tourism demand was very different in the pre-COVID level. Retail demand was a very different pre-COVID level. What is the best way to understand the management commentary from consumer companies, from steel companies, which is coming along with their quarterly numbers?
I think the management commentary has to be married with where the stocks are trading, right? So if you find that the stock isn't pricing everything that the management is saying or what your own assumption is, just for example, we do think that, in the auto space, two-wheelers is a space that would come back. We haven't seen great growth if you go back last 5 years. Leave the COVID aside. There wasn't, we're talking of single-digit growth in two-wheelers. So we do think, given all the changes and all the growth that has disappointed over the years, and given what has happened because of the pandemic, we think that two-wheelers and personal mobility as a requirement, we will see good growth. We've seen this even in the past. You go back to, say, 2009-10, there was a period when rural demand was very strong because of all the stimulus that the government had given. That had resulted in very strong double-digit auto growth, especially two-wheelers. We think that could repeat. So I think the question of how you read all the numbers, how you read the data points, some of them you will get right, and some of them you may not get right. So I think it's a question of how you position yourself, how you read. At this moment, we think auto is a good space based on what the managements are saying and based on also what history has told us and how the rural economy is shaping up right now.
Interesting. Sridhar, I just want to also get the overall context in terms of what's happening globally and to what extent you feel our markets are going to be interlinked with that. We've got the elections coming up, constantly on our toes with the vaccine news as well. So there's a fair amount of uncertainty that we're heading into towards fall. Do you feel that there is enough strength or domestic interest in the markets currently to withstand any kind of volatility that we might see on that front?
So I think we've seen even from the March lows that our markets do dance to the tunes of what happens to the global markets, especially the US markets. And I think the most important event for the US markets is, of course, the elections. And at least from whatever I read, it suggests that, if Biden were to come, that may not be great for the markets in the short term. But having said that, there is also a view that it is quite good for emerging markets in general. Commodities may do well. So there are multiple views on this. I think at the end of the day, if the earnings for our own markets start to rise, say by the third or fourth quarter, we would be able to withstand some of it, but not all. So if the markets globally were to correct, I think our market would also correct, and that may be quite healthy. I mean, we've seen a one-way market, from the lows in March to where we are right now. So in my view, that may be a good, point where people who are on the sidelines or people who may want to churn their portfolio, that may be a good time to do it.
Okay. And in terms of, a churn, I mean, you mentioned auto. Where else would you feel it's, it's prudent to really remain invested at this point? You talked about a little bit about frontline financials. Let's talk a little bit more about that and perhaps how you see financials panning out now going forward, given that we've seen them take a little bit of a breather post all of the fundraising that we've seen in the last few weeks.
Yeah, so within the financials, our preference is for the larger private sector banks. One, because, they've all managed to raise capital. We do expect that there could be a spike in NPAs. Honestly, not even the banks, none of us can even guess right now what exactly that number is going to be. Hypothetically, we take the number what Reserve Bank has suggested, and if the actual number for the private sector banks were to be lesser, then I think there is an upside to these, stock prices for the private sector banks. The market currently, in my view, is pricing in what Reserve Bank has suggested, which is about 400 to 500 basis points increase. And the private sector banks, in my view, are well positioned because one, they have raised capital. Two, competition for them is substantially reducing. So the competition from NBFCs, competition from PSU banks, a lot of that is coming down. The conversations with them is suggested that they are able to pick and choose based on their risk perception. So I think they're very well positioned in terms of their liability franchise, in terms of how they position themselves on the asset side. And also given that many of them have provided substantially for the COVID-related and also their previous NPA cycle that we saw. So broadly, that is our view. I have never been a big fan of NBFCs or HFCs, and I maintain that that business model has to substantially change. So as far as financial is concerned, it's quite simple. Just stay put with large private sector banks and avoid all the noise in the sector otherwise.
But Sridhar, just on that point about, top financials that you're making, do you think one would have to stay put for a very long haul? Because even within the top financials, you're not really seeing a big bang move come in across the category. I mean, we were just chatting about ICICI Bank, for instance. Irrespective of 49 out of 50 brokerages being bullish, having buy calls in ICICI Bank, it's struggling to, push forward beyond 340, 350 thereabouts.
Yeah, so I think if you see the only sector that hasn't really reacted much, I mean, they have all corrected or moved up from their lows, but it is well documented that this is the sector which has to see the maximum pain. So I'm not surprised that they haven't really gone back to their previous highs or haven't even come close to it. I mean, year to date, I think financials are down almost 25-30%. And I think that's a fair. My point was from here on, given all the capital raise and given all the pessimism that we are seeing right now, the risk reward on the private sector banks is looking far better than it was, say, 3 months back. So that's my limited point. We do remain underweight on financials as a sector. But within that, you can't be zero in the sector. Within that, we find the private sector banks to be, the risk reward seems to be much more favorable right now than it was, say, 2-3 months back.
Theme which is playing out right now is the entire Contra theme. People are finding merit in nibbling into some of the aviation names, multiplex stories, hotel stories. Where do you stand when it comes to the Contra theme?
I guess Contra theme has been commodities. Say back in March, April, even now, they were trading at 0.3 book. And now we are at, say, 0.5. I was seeing a very interesting chart where somebody had forwarded a 100-year chart of Dow Jones versus the Goldman Sachs Commodity Index. It's a ratio, and that ratio normally averages around 0.5, and it was at 0.1. It had never seen that lows. The last time it saw lows like that was in the 1960s. So you're really talking of commodities getting crushed over a 100-year period. Even if it were to, go back to its mean, which is at, say, 0.5, you're talking of a 5x move in commodities over a period of time. For us, that's the easiest trade. As a house, we've invested in commodities quite well in the past. All of them, including steel, aluminium, you name it. In fact, I like gold and silver also, but there aren't too many plays in India for that. But commodities in general is a space as a contra play we think is very exciting.
Oh yeah, it sure is, and it seems like the move has just about begun, at least when it comes to the ferrous and non-ferrous metals. But tell me, what about the other sectors that I mentioned, Sridhar? What about aviation? What about hotel stocks or multiplexes? Would you give them a go at all?
So some of the sectors we don't, as a house, invest because of some restrictions that we have, especially hotels. Aviation, I would still stay away. I don't need to participate in every sector that is moving up. Having said that, possibly if the multiplex sort of entertainment space is something that is worth considering. We actually have looked at this in a slightly different manner. In fact, we have gone long on the media space, which again has got crushed with the whole view that OTTs are taking over, and media companies it's curtains for them. We think that space is looking much better than actually the multiplex space. So we are quite bullish on media in general. This is the GEC space. Given that, as you mentioned, that advertising revenues seem to be coming back. Currently, it's priced for almost 50 to 60% fall in advertising, but subscription revenues continue to be very buoyant. In fact, they're growing on a year-on-year basis. And the valuations of these companies look very attractive. They're also cash-flowing companies. Some of them have 5 to 6% dividend yields. So I think there are many contra plays, and I think different houses look at stocks in different ways. This is how we are seeing the contra plays. As I mentioned, commodity is one, media is the other, which we think is not today spoken about much.
Sridhar, let's understand, how does one value a company like Reliance now? I'm being stock specific here because this is one big name which in a sense has really changed the market dynamics and outlook for the telecom stroke digital business in India. Do you think a stock like Reliance for a long haul investor is a must have now?
Speak specifically on Reliance, but telecom as a space, we've been very bullish for a long period of time, at least for the last 18 months to 2 years, we've been long on the space. And a simple, view on this space is being that, a $2 ARPU cannot last for too long. I mean, this is a number I've given in the past also, that about 2 years back, the industry revenues were about 2 lakh crores. And today we are talking of 1,50,000 crores. So there's been a substantial shrinkage of the industry revenues, maybe because of what happened to Jio and the data pricing and the ARPUs, the way they have collapsed. We do think that the ARPUs for the industry will go up. You see, look at the commentary that we've seen from all the players, and the general consensus is ARPUs will go up. Keep in mind that, the stock that you named, that is also some sort of a play on media, on telecom, on integrating many of these platforms together. And if some of the giants like what we have seen have come into that company, obviously they are doing something right there. But I think the basis for the valuation for that company comes from the fact that ARPUs have to go up. $2 ARPU cannot last. So we are long, telecom in general, and we like all the telecom companies in that space. There are very few left there, but I think it's a space that one should be long because the dynamics can only improve from here. And I think it's a space that one has to be invested in. I mean, you can pick and choose whichever stock you want.
What will be the importance of the AGR issue? Whichever way the decision would know, we don't know. But would you be long on telecom irrespective of the AGR stumble or the AGR decision?
So I think based on the commentary that I've seen from the government and from all the arguments that we've seen in the court itself, it is very clear that the government is keen to have at least 3 to 4 players in the market. You don't want a sort of a duopoly in the market, and that's the view of the government also. So I think the AGR issue will get resolved. It's sub judice. We'll have to wait for what the Supreme Court has, the verdict that the Supreme Court has to give. But if I go by what has been the plea, we're talking of AGR revenues being, split over 15 to 20 years. Either way, it should be, fine. I mean, that's the broad view that's how this AGR issue gets resolved for now.
Okay, so let me get an overall picture then, Sridhar. You mentioned autos, you mentioned private banks, of course. What else? I mean, a lot of people have been trying to tap into some of the newer opportunities emerging, such as specialty chemicals, the agri theme, for example, maybe even for a longer term play, something in manufacturing. While you may not want to go for everything that's moving, are there some newer themes that you're looking at as well, or just sticking with the sort of select basket?
Agri is a theme that we really like. I think the fact that we've had some really path-breaking agri reforms in the last 3 months, the fact that, the APMC Act, the essential commodities, and the impact that this has on the agri ecosystem, the investments that are expected to go into this sector, we think that over the next, say, 3 to 5 years, we will see very exciting opportunities. So we are actually invested in many of the agri themes, including fertilizers, seed, the chemicals, the entire ecosystem that we have right now. But keep in mind that the investable universe in agri today is very limited. Private sector is hardly invested in this segment. But we do think that the second derivative impact of this will be very positive. The fact that the rural incomes would stand, the farmer would stand to benefit. As a result, rural incomes would be higher. And this can help even consumption, discretionary, non-discretionary. So we are quite, constructive. We are invested in many of the stocks in this sector. Also, what we like is the chemical space which you mentioned, which is specialty chemicals, which basically is in a way, benefiting from what is happening to China and many of the global industrial companies and chemical consumers moving away or wanting a second, option apart from China. So we think that's a space which is very interesting. We've been fairly well invested in that segment. So as I said, there are many opportunities. Some of them become very stock specific. Some of like textile exports is another thing which is a very stock specific opportunity, but we do see opportunities even there. So I think this market incrementally is becoming more stock specific given where the markets currently is, the sharp valuation move that we've seen. So that's how I would see.
For joining us this morning, Sridhar, and sharing with us your views.